Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Turkish economy. And Turkey is a country that I've now been covering for more than 3 years. If you follow mainstream media, you might not have seen many articles on Turkey recently because the mainstream media only really wants to talk about Turkey when inflation is at record-breaking levels. And over the past 4 months, inflation has actually started to decrease in Turkey, which is obviously really good news for the economy. However, it's not that good news because the current rate of inflation is still around 50%. And 50% means that Turkey still has one of the highest rates of inflation in the whole of the world. Now, over the course of the last 12 months or so, President Erdogan has actually changed his policy. Prior to that, he was tackling high levels of inflation by decreasing interest rates. And that was contrary to traditional theory. Usually you would expect interest rates to go up at times of high inflation. However, following his re-election in 2023, he decided to have a change of heart, and over the last 12 months or so, we've seen a rapid increase in interest rates in Turkey, and the current level is sitting at 50%, and I mean 50, not 15%. And 50% is obviously prohibitively high. If you're a company in Turkey, the last thing that you would want to do right now is to borrow money at an interest rate of 50%. So what's going on right now in terms of inflation and interest rates is really quite interesting. So in today's video, we'll take a detailed look at exactly what's been happening. We'll also have a look at the money supply because the central bank in Turkey has been pumping money into the economy to try to get it kick-started, what's called quantitative easing. However, the problem with quantitative easing is that it tends to fuel inflation, so it pushes up prices. And that's one of the factors that has led to the high levels of inflation in Turkey right now. So we'll have a look at what's happened to the money supply. We'll also have a look at what's going on with the Turkish LIRA, because that's continued to fall in value. And this is causing more problems for the Turkish economy because as your currency falls, that means all of your imports become relatively more expensive. And Turkey is a net importer. So that is having a massive impact on the economy. And then finally today, I'll wrap up with my summary. So what I think is going on right now in Turkey, whether or not the new policies are starting to bring inflation back down and under control, or if Turkey still has a very long way to go on its road to recovery. But before we get started on all of that, I'd like to say once again, thank you so much to everyone that's supporting the channel. If you're a long-term supporter, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you so much for that long-term support. Your monthly support really helps to keep me going, makes me think up more ideas for videos on a regular basis. And if you've bought me a coffee or sent me a YouTube super thanks recently, thank you so much for the time and the effort and the generosity involved in that. I do see those messages, I do read them, I don't get a chance to respond to all of them, unfortunately, but thank you so much, it really means a lot to me. This chart shows the movement in the official rate of inflation in Turkey over the past 12 months, and one very important thing to note about this chart is that the scale on the right-hand side does not start at 0. It actually starts at 47% and goes up to 82%. And what this chart shows is that 12 months ago in September 23, inflation was above 61.5% in Turkey. And over the following 8 months, there was a progressive increase in the rate of inflation, and it hit a 12-month high of 75.45% in May 24, which meant that at that time, Turkey had one of the highest inflation rates in the whole of the world. However, as you can see, over the past 4 months, there's been a marked improvement in the rate of inflation. It dropped down to 71.6% in June, 61.8% in July, 52% in August, and the latest figures for September 2024 show that inflation is now down to 49.4%, which is the lowest level that Turkey has seen since July 2023. So you might be sitting there thinking, well, that looks like really good news. But obviously, you always need to take a step back and look at the figures that we're talking about. And an inflation rate of 49.4% is still incredibly high. And if we compare the current rate with the rest of the world, Turkey still has the 6th highest rate in the world. There are only 5 countries where inflation is higher than 49.4%. And if we widen the scale of this chart to show what's been happening over the past 3 years, you can see that there's also an additional problem, because the current inflation rate of 49.4% basically measures today's prices against prices from 12 months ago. And if we look at the situation for September 2023, the year-on-year movement last year was an increase of 61.5%. So the 40.4% is in addition to the 61% increase that was seen last year. And if we look back to September 2022, you can see that inflation was running at 83.5%. So the 61.5% in 2023 was on top of the 83.5% increase seen in 2022. And if we look back further to September 2021, inflation was running at 19.6%. So when you think about the cumulative impact of the year-on-year increases in inflation, we are talking about prices rising incredibly rapidly over the course of a 3-year period. And that's one of the problems that Turkey now has. Even if it brings its inflation back down to a single-digit level, it's built on top of all of this huge amount of inflation from the past. And that's one of the reasons why prices have got out of control, and also one of the factors in the rapid deterioration in the value of the Turkish lira. So whilst the trend for inflation over the past 4 months is very positive, we're seeing a month-on-month reduction. That reduction needs to accelerate. It needs to come down significantly from the current level of 49.4% to a more manageable level if Turkey is going to get its economy back on track. This chart shows the movement in food inflation in Turkey over the past 12 months. And this is a metric that I always like to look at because it tells us what's going on with regards to food prices and therefore what's happening with the poorest members of society who spend a higher percentage of their net income on food. And what this shows is that in September 2023, the year-on-year movement in food prices was above 75%. Over the following 8 months, the increase in prices remained at or around 70%. However, over the past 4 months, there has been a fall in the rate of increase to 68% in June, 59% in July, 45% in August, and the most recent figures for September 24 show that food prices increased year on year by 43.7%, which is actually the lowest rate of increase since November 2021, so almost 3 years, which is obviously a positive development. However, a year-on-year increase of almost 44% is still incredibly high, and ranks Turkey as the 5th most expensive country in the world in terms of the year-on-year movement in food prices. And once again, if we widen the scale of this chart to look at what's been happening over the past 3 years, you can see that in September 23, food prices increased by 75%. So the current increase of 44% is on top of that 75% increase last year. And in September 2022, the increase was 93%. So when you've got that sort of level of increase every single year, it means that food is becoming less and less affordable, particularly for the poorest members of society, who are the ones that suffer the most at times when food prices are rising rapidly. So despite the fact that food inflation has been coming down in every one of the last 4 months, there is still a major problem with food prices in Turkey. This chart shows the movement in the official rate of interest in Turkey over the past 3 years. And as we've talked about lots of times on the channel, the traditional way of dealing with high inflation is to increase interest rates. Now, in the past, Turkey was operating an opposite policy to this. It was actually reducing interest rates at the time of high inflation. That policy didn't really work. And so following his re-election in 2023, President Erdogan changed the strategy and started allowing interest rate increases. And what you can see from this chart is that since June 23, there have been 9 consecutive interest rate increases from the original level of 8.5% to the current interest rate of 50%. And yes, you did hear that right. Interest rates are currently at 50% in Turkey. So if you wanted to take a loan, the base cost would be 50%, and then the bank would need to add some profit margin on top of that. And when you're talking about a base cost of 50%, they're likely to add maybe 5 or 10% at least. So you would be paying 55 or 60% interest every single year for that loan. Now, clearly, that's a prohibitively high rate, and that means that if you're a company in Turkey, you're unlikely to take a loan at the moment to invest into your business. You don't want to expand if you're having to pay something like 60% interest per year on that money. So the current excessively high rate of interest in Turkey is really bad news for the Turkish economy. And this table shows that Turkey currently has the second highest interest rate out of every single country in the world. The only country that now has an interest rate higher is Venezuela, where it's touching 60%. One of the main instruments that a central bank uses to try to control what's happening in the economy is the supply of money. And over the last 15 years, we've seen the supply of money used quite a lot all around the world. Following the global financial crisis in 2008, the USA embarked on what's called quantitative easing, whereby they were looking to pump a lot of money into the economy to try to get it kick-started. And the way that that's done is the central bank starts buying back bonds in the open market. So the way that works is that the financial institutions that are holding lots of bonds sell those bonds for cash. They then have a lot more liquid assets. They've got a lot more cash. And so the financial institutions are then motivated to use that cash as loans, give it out to lots of companies and individuals. Those companies and individuals take that cash, they then spend it on a variety of different things. That increases the spending and the demand in the economy and therefore starts to grow GDP. But one of the problems that you have with quantitative easing is because it's an expansionary policy and it encourages spending and demand, it tends to drive up prices and therefore pushes up inflation. And that's one of the problems that Turkey has been facing over the course of the last 3 years as a result of a rapid increase in its money supply. This chart shows the movement in the money supply in Turkey over the past 12 months. And what you can see from this chart is that there has been a rapid and consistent increase in the money supply in every single one of the last 12 months. And if we expand the scale of this chart to show the situation over the past 3 years, you can see that we've almost got a 45-degree angle here. The Turkish central bank has been rapidly increasing the money supply. And this is because they want to get the economy kick-started. They're trying to get things going. But as we've just discussed, the downside of rapidly increasing your money supply is that it tends to push up inflation, and then you have other problems arising as a result of high inflation. And if we expand the scale of the chart to show the situation over the past 5 years, you can see that between September 2019 and September 2021, the increase in the money supply was moving at a much more pedestrian rate. However, from October 2021 onwards, there was an acceleration in the money supply, and that's one of the factors that has led to such high levels of inflation over the past few years. This chart shows the movement in the exchange rate between the US dollar and the Turkish lira over the course of the past 12 months. And what this shows is that 12 months ago, one US dollar was trading for 27 Turkish lira. Today, it's trading for more than 34, which represents a fall in value over the last 12 months of more than 25%. And if we expand the scale of the chart to show what's been happening over the past 5 years, you can see the significant fall in value. 5 years ago, one US dollar was trading for 5.5 Turkish lira, which means that the current exchange rate represents a fall in value of around 6 times over the past 5 years. And I think one interesting thing to note about this chart is the change in the angle that occurred around September 2021. The value of the lira declined between October 2019 and September 21, but at a much slower rate. However, following the increase in the money supply and also the decision that was taken at that time to start to lower interest rates, we saw an acceleration in the fall of the value of the lira. And the huge fall in the value of the currency over the last 5 years is one of the factors that has led to a high level of dollarization in the Turkish economy right now. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following the events in Turkey for more than 3 years now. And what we've seen over the last 4 months is inflation has started to turn the corner. It's actually coming back down. But as we've talked about, it isn't cause for celebration just yet, because inflation is still sitting at 49%, and that makes it one of the highest rates in the whole of the world. And so that's clearly still a major problem. But in conjunction with what's happening with inflation, Turkey now has a problem with interest rates, because its interest rates are actually now higher than its inflation. Interest rates are at 50%, inflation is at 49.4%. And what that means is that nobody in Turkey wants to borrow any money. You wouldn't go to the bank and take out a loan if you could avoid it right now, because you'll be paying more than 50% every single year on that. So basically, if you took out a 3-year loan, in the first year, you'd have to pay back 50% in terms of the interest. The second year, a similar amount. And the third year, a similar amount. Obviously, the balance would go down. But if it was an interest-only loan, it wouldn't. So the cost of repayment is absolutely astronomical in Turkey right now. And what that means is that if you're a business, you definitely will not want to borrow to invest into your company, to expand and to grow your entity. You wouldn't want to borrow money to take on more staff, for example, because at the moment that would cost you over 50% for the actual borrowing costs, and also because wages are rising rapidly in Turkey as well to try to counter the impact of inflation. You'd also have to be paying a large amount out for all of the people that you took on. So 50% interest rates aren't really very encouraging in terms of people deciding to borrow money and invest either into their business or to buy property or things like that. And alongside what's happening with inflation and interest rates, what we've talked about today is that the central bank has been pumping money into the economy. It's been following a quantitative easing program to try to get the economy kickstarted. And this was something that we saw after the global financial crisis in the USA and also after the COVID-19 pandemic. And quantitative easing works well if you have very low interest rates. So basically, if you've reduced your interest rates to virtually zero, as happened after the COVID-19 pandemic, there isn't really much else you can do in terms of interest rates. So the next lever to pull as a central bank is to start pumping money through quantitative easing. But what we're seeing in Turkey is quite unusual because their interest rates are actually at 50%. So in terms of encouraging people to spend, they could lower those interest rates significantly if they want to do that. But what we've got is a combination of very high interest rates, which is basically putting the brakes on, telling all companies and individuals not to borrow any money, to slow down spending, to try to bring inflation back under control. But at the same time as that's happening, it's putting its foot on the accelerator through the quantitative easing program. So we've got a slightly mixed message in terms of what's happening in the economy. And what that's resulting in is spiraling inflation over the last 2 years and really high interest rates. Now, inflation has started to come down, but not as rapidly as you would expect, given that interest rates are the second highest in anywhere in the world right now. 50% is incredibly high. And the combination of all of these factors has led to the value of the currency continuing to diminish. And one of the major problems that the fall in the value of the lira has caused for Turkey is that over the last few years, the Turkish people have started to lose faith in the currency. When you've got a currency that's falling in value so rapidly, you prefer to use somebody else's currency. So people in Turkey prefer to use the euro or the dollar, and that makes it difficult for the central bank to be able to get control of the economy, because when you're increasing interest rates but nobody's actually dealing in your currency, it has a much lower impact than if everybody is using your currency on a regular basis. So the overall summary of today's video is the good news coming out of Turkey is that inflation is now on a downward trend. The last 4 months have seen a constant reduction in inflation. However, the problem is that that reduction isn't happening quickly enough. We've still got inflation at a very high level, 49%, one of the highest rates in the world. Combined with that, the Turkish central bank have increased interest rates to 50%, which is second only to Venezuela at the moment. And that tells you that there's a serious problem in Turkey when there's only Venezuela above you on the league table. All of that is forcing down the value of the lira, which is making it less attractive for the people in Turkey to use. They're now turning to alternative currencies, making it more difficult for the central bank to actually get things under control. And all of this tells us that the problems in Turkey are continuing, and it's likely that over the course of the next 3 to 6 months, we'll see a continuation of this situation. We may well see inflation continuing to go down. We may see interest rates remaining at a high level. We're likely to see the lira continuing to fall in value. If the Turkish central bank keeps pumping money into the economy through quantitative easing, then that will continue to push up inflation. And all of this means that the Turkish economy is facing a very difficult end to 2024, and the prospects for 2025 remain similar to what we're looking at right now. The Turkish economy is struggling. It needs to generate more GDP. It needs to improve its manufacturing output. But the problem is, because of the issues in the economy, overseas companies are reluctant to invest into Turkey right now, and so it's difficult for it to get itself out of this situation. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.